guest host, moderator for our next session on stage, who is Glenn Ellis. And through his career, Glenn Ellis has been an underwriter, a broker, and a risk manager. And he's interviewing Ian Meadows and Richard Wilson from IncubEx to talk about carbon markets and carbon trading. Over to you.
Thank you. Good evening, everyone. My name is Glenn Ellis, and I'm with pleasure introducing Ian Meadows and Richard Wilson from IncubEx. And we're tackling a topic tonight that is very, not only topical, but one that personally I am extremely interested in. So let's hope we can engage you on this one. I think if we just set the scene to start with, gents, in this rapidly growing and complex carbon market, what does IncubEx offer? And I suppose a corollary to that is, let's understand what you mean by carbon. Please.
Do you want to take that one first?
Yeah, I can go first. Good evening. We are basically a trading venue or a procurement venue for trading carbon. Now, I think it's very important that the biggest part about carbon that people hear about these days in the press is carbon credits or voluntary carbon. But there is also a very large fundamental area that's around $1 trillion in turnover, which is around compliance carbon. And that's the carbon allowances that there's 56 different carbon schemes that are compliance led by local governments, the largest of which is in Europe. And this is the EU ETS, and these are called carbon emission allowances, as I say. Anyone that is involved in generating power, steel, cement, glass, so high-intensity energy consumption. And actually more recently, which is quite interesting, I think, for a lot of the folks in the room here, is the maritime business. So that's the piece that is the allowance area. So in Europe, we're looking at about a €60 price per ton. And then there's the other piece, which is often deemed as voluntary. I don't like that word. Offset, I don't particularly like that word either, which is where we get, there is the bad press side to it, but we'll go into that in a little while. So we offer a venue with our trading partners for people to come to market and either trade the product or procure, because a lot of people, when you speak to corporates and you say, do you want to trade these? They say, no, we don't have traders. We don't have traders. We don't like risk. That sort of risk. You're all risk managers. We don't like risk. The trading is a bad, risky area. But you have a procurement department, so you can come in and procure.
Exactly.
So yeah, I think certainly from an IncubEx perspective, what I've seen for people in the room here, we work with the world's the largest energy companies, banks, and increasingly shipping, transport, aviation businesses, multinationals who need to worry about not just reporting on their emissions, but actually having to do something about it. And then that also includes worrying about what they need to do on carbon credits. So we sit in the middle of everybody and work with exchanges and build our own platforms to allow the market to connect to the world of environmentals, which is carbon emissions and carbon credits.
Good. Well, renewables, it's a word on everyone's lips, and there's an opportunity here possibly for companies to arbitrage, even trade in the energy market, obviously whilst at the same time reducing their carbon footprint. But really, is this just speculation, and if not, where might IncubEx feature in that scenario?
So, just to provide a bit of context for everybody, for most businesses now, corporates in particular, need to worry about thinking through reduction in emissions and also therefore switching off fossil fuels. So there will be demand in renewables as we go forward, and that can either be bought and sold in regulated markets, as Richard said, or it can also be in the voluntary markets too. So renewables probably was a speculative trade, but now becomes a very real issue, because businesses need to work out how quickly they can transition and move away from fossil fuels. And insurers are the same. They need to worry about what the carbon intensity is of their clients and where the transition is underway. But I don't think it's just speculation. So maybe you've got something you can add to that.
Yeah, if we look at Europe specifically, there were the EU ETS, the compliance business, which is about turning off fossil fuel. So the EUA started in 2005. By 2015, well, by 2020, sorry, there was deemed to be a 21% reduction in carbon output from fossil fuel burn. And that number was actually hit by 2015. Might have been towards the end of 14, actually. And that's compared to the mid-1990 number. So it has worked. I think that you will find Northern Europe is, as in the Nordics, it is all renewable energy, mostly through hydro. It's a very real area. So through the early teens, obviously there's subsidies, government subsidies. Now that the government subsidies are pulling away, there is the opportunity to actually get a different type of credit, which in the States is called a REC. Actually, globally, they're called RECs, renewable energy certificates. And for every megawatt that you produce mainly through wind, solar, and hydro, there is a degree of bio on there as well. In Europe, they're called guarantees of origin. And we supply a venue for people to, when they have generated that power, because obviously the investment is there for the power. It's not the same as having a burn rate of fossil fuels. Is you have another avenue to market to actually make some money to actually fund this development. And if we look at that carbon allowance number, it's all around fuel switch. And where does it make sense to actually turn off fossil fuels and actually invest in renewable energy? And it is around, in Europe, it's around 65, 70 euros per tonne. So we're at that sort of number. It's taken a while to get up there. The European government had to reduce the amount of allowances that are out there in circulation. Once that happened, we did rally up to around $100 euros per tonne. It came crashing back off over the Ukraine war.
So there's capacity out there. So trading volatility is really providing capital market capacity to trade. For most corporates on the ground, this is about how do I now move to a green tariff. And that's all done through a renewables contract, effectively, that can be bought and sold. So that's measuring scope 1, 2, 3 emission, and then how do you look to switch? Importantly, I think where the insurance markets are concerned, and particularly now with renewables, this industry is going to be massive. It's $250 billion, $500 billion already, and it'll be 1.25 trillion at some point soon, including e-fuels. So getting to grips with what the overall supply is concerned and the risks associated with it is something that insurers are massively keen to now look at and address. And some are also getting involved now in trading renewable certificates themselves because they're taking revenue risk on the balance sheet and then trading effectively like a reinsurance contract, but now trading into the derivatives markets.
And I think if we look at a real life example for the risk managers in the room, is Suez Canal, or the issues around the Arab states at the moment for the vessels, and where the maritime industry for the burn of the fuel that they're on every journey into Europe is accountable, and you've now got to go around the Cape. It's a far larger burn of fuel that actually creates a higher number of EUAs these allowances that you have to buy. So you've got insurance companies starting to look actually. How is this going to affect us, and what is this market?
Yeah, fascinating. You mentioned scope 3 a moment ago, and I don't want to take us off down a rabbit hole, but that's an issue I know is concerning risk managers in terms of, well, how do we measure this? What are the emissions of our suppliers? But that's for another session, maybe.
Yeah, I wouldn't open that one.
IncubEx has partnered with the Toronto Stock Exchange and JP Morgan and launched a climate marketplace called TVCM. I wonder if you could put some realism, if you like, put some colour around this and what this might actually mean, and maybe bring to life a couple of examples for the risk and insurance managers in the audience.
So, I'll dumb this down for most people who don't sit in the carbon markets every day as well. So carbon credits, we've seen plenty of press around what they are and what they aren't. There's 30 to 50,000 projects globally, and they can be anywhere between nature-based projects to soil, to blue carbon, protecting oceans, and they can be seaweed. They can be seaweed. Actually, we did look at the seaweed in the audience a second ago. So yes, if your hotel is having a problem with the claims, so you can probably offset that and get a carbon credit and resell. But there are so many of these different projects that are investable. The market's 2 billion, but it's set to rise to 5, 10, 20 by 2030. But it needs consistency and it needs transparency, just like any other market needs infrastructure. Otherwise, it's a very over-the-counter, bespoke way of working. So price discovery and transparency and consistency and quality has been an issue. So the way we've looked at building out is to provide access to all markets, to the global providers of carbon credits in whichever way, shape or form they provide them, which gives you complete transparency. That's what we've done. And there's also elements of counterparty risk that we deal with through, obviously, the settlement process with JP Morgan. Is there anything?
No, I think if we look at, once again, a sort of real-life example in this space, carbon credits certainly went bonkers around 2018, 19, 20. There's a devil if you do, and you're a devil if you don't. And I think many people will have read about Delta having a class action suit raised against them out of California for operating in a market that's voluntary. Okay, it's their choice to claim or make these claims, which were right, but it's the way they did it. So we can't turn off or go to net zero overnight. So you've got to be on a journey. You've got to write a rule book about your journey, about how you're going to reduce your emissions over let's say Fit for 50, or for 55, but it is actually, there's a massive aim towards 2030. There's different triggers the whole way along. Now, if you do nothing, you're going to get a class action suit against you. So, we're talking to many corporates about the fact that don't overstate the claim. And anybody, obviously, around from the trading world will remember old Nick Leeson. It's almost put them in the 5/8 account drawer in the bottom and sort of forget about it. But as if someone comes after you, you can turn around and say, no, we did it, but we weren't over-exaggerating what we've done and where we've gone. So, and I think the best way of looking back at that is if you smoked in the 60s, 50s, 60s, and 70s, no one warned you about it, and everybody got sued in the 80s and 90s. So it's actually just, you've got to cover your back, and you can't just ignore it. So there is still a huge amount of action in there. I think that is down to some of the governing bodies to actually say, the bottom 50% are rubbish. You've got to pick and choose exactly what you're going to look after, but you've got to be in there and get involved.
And given those challenges of compulsory legislation, the need to reduce carbon emissions, and possible use of voluntary carbon markets as well. I mean, how do you see the role specifically of the risk and mainly the risk manager, of course, but the risk and insurance managers evolving in this space? And particularly, how do they demonstrate added value opposite, say, the sustainability manager?
So it's complicated, I think. Especially at the moment. So if we take the view of why people are using carbon credits in the first place and what insurers are doing about it, that's also something to come on to. But ultimately, heads of sustainability have been looking very much at transition risk and how to decarbonize, and then how to drive change throughout the organizations, changing globally what the supply model ultimately looks like. Risk managers typically have been looking at physical loss of damage and major climate risk issues, and of course the two then have to combine. So now really what we're talking about is, particularly in Richard's example, taking transport or even commercial property, where you're having to look at dealing with regulated industries and what you're emitting, how quickly you're shifting, where your investments are globally, and how you're using carbon credits to replenish natural resources, or whether you're using them to offset. There's a myriad of risks that then need to come together. So heads of sustainability will increasingly work with risk managers to really understand what the hedging risks are as much as what can be risk transferred into insurance. We don't think very many people are really there yet. So when we talk to heads of risk and insurance at the moment, some of the biggest firms who have been trading in carbon, buying carbon credits for a long time, still a lack of data, still a lack of knowledge, still a lack of sharing internally. But it should be front and center to what the choices are going to be for economic risk.
I'll add a little piece, which is, if we go back to the maritime industry, we are seeing, as I say, we refer to the fuel use, which is covered by the EU ETS, the compliance market. If you're transporting a cargo of coal up to Europe, we're now, your vessel and the owners are getting concerned on the charter route about the impact on Poseidon Principles and CII. So this is then having a financing impact to the vessel, which is from the voluntary side because it's about the cargo that's being transported. But it's also, we're starting to see the odd insurance companies say, well, actually, yes, we will insure you, but we want to make sure that you are actually offsetting the cargo. So you're operating on the compliance side from the fuel going in the bunker, but then you're also having to look at the the voluntary market, the carbon credit market, to actually offset the damage that fossil fuel is going to do when it's burnt in Europe.
I'm looking at the timing. We are short, but I really would like to ask one last question, which I know will resonate with many members in the audience, which is about captive insurance companies. Captive insurance companies are a very important part of the overall risk financing strategy. But have you seen any evidence of captives being used in VCM projects? And if not, maybe there's a trick being missed here.
Well, I think the first answer is what credits are being used for. So you've got the obvious example where businesses are looking to offset emissions and carbon that can't be abated. So that's a classic example of, well, I've done everything I can, and now I'm going to offset the rest. You have other firms who are looking proactively and investing in biodiversity projects because it's important to their brand. And that's the same with the insurance sector, who believes that investing in nature-based projects will protect oceans and build flood defenses and build a lot more resilience into the system. But you do also have some businesses, including managed from the captive, where there are going to be losses, and to make sure that healthcare systems are stood up in the right way post-loss, then they're relying on carbon credits to do that. So there's a sort of an operational a management approach to use of carbon credits in captives. But I think also, as insurers now step in to say, we offer all risks, we offer political risk, we offer fraud and negligence, we do forwards and future investments, we do credit insurance, it starts to offer a little bit more visibility to risk managers and of course captives around what can be retained on balance sheet and then what gets transferred into the industry. So I think it starts to become quite interesting at that point. But they still are getting, I think in many cases, getting the data sorted first to figure out what the options are, and then perhaps we'll see a little bit more.
Richard, did you want to add anything to that? Well, we have overrun, apologies, but thank you very much indeed. And if we'd like to say thank you in the customary fashion, thank you.
No, pleasure. Thank you.